The crisis began quietly, almost too quietly for the world to notice. In the early hours of a misty morning along the Baltic coast, cranes that once swung endlessly over cargo ships stood still, their shadows stretching across deserted docks. Russia's major ports, St. Petersburg and Kaliningrad, had long been symbols of power, proof that Moscow could bridge east and west through trade and influence. But now the silence was heavy, unnatural, and the few workers who remained on site could sense that something irreversible had happened. What was first described as temporary maintenance delays soon evolved into a complete halt of operations. Cargo ships that had already set sail turned back mid-voyage, unable to dock or unload. Containers filled with oil, gas, metals, and grain piled up in holding zones, while customs officials received orders that no one could explain clearly. Some blamed technical glitches, others pointed fingers at sanctions. But those within the government understood the truth. Moscow's access to the Baltic Sea, the crown jewel of its Western trade network, had been severed. Behind closed doors, panic spread through Russia's Ministry of Transport. For decades, the Baltic ports had been essential to Moscow's economic survival, responsible for billions of dollars in exports and imports. Without them, energy shipments to Europe would slow to a crawl, foreign goods would dry up, and the ruble, already under immense pressure, could face another sharp decline. State media worked tirelessly to downplay the situation, claiming that operations would resume shortly. But satellite images told a different story. Rows of ships floated motionless offshore, waiting for clearance that never came. Insurance companies began canceling coverage for vessels entering Russian ports, citing an acceptable geopolitical risk. Foreign logistics firms, including some that had operated in Russia for decades, quietly evacuated staff and assets. By the end of the week, warehouses were locked, shipments rerouted, and the hum of commerce that had once defined Russia's Baltic corridor had faded into eerie silence. Traders in Europe and Asia reacted with alarm. Global supply chains, already fragile from previous disruptions, felt the shock immediately. The cost of transporting raw materials through alternative routes surged, forcing smaller companies into losses overnight. Finland and Estonia reported sudden increases in cargo traffic as shipping firms scrambled to find new pathways around Russia. The Kremlin attempted to spin the crisis as an opportunity to build self-reliance, but even domestic analysts knew that was wishful thinking. The Baltic ports had never just been about trade. They represented Russia's access to global influence, the physical link between its vast resources and the international markets that consumed them. Losing that meant more than just lost revenue. It meant losing leverage. As the situation in the Baltic worsened, attention shifted south to the Black Sea, where tensions were already running high. The region, long a battleground for influence and access, was now under extraordinary strain. The Black Sea ports, including Novorossiysk, had served as Moscow's southern trade lifeline, connecting oil and grain shipments to the Mediterranean and beyond. But with the Baltic routes collapsing, the burden on the southern ports became unbearable. Then came the restrictions. Regional partners, especially Turkey, Romania, and Bulgaria, introduced tighter maritime checks. Citing security concerns, Western insurers followed, refusing to cover vessels navigating near Russian-controlled waters. Foreign companies, fearing sanctions or political backlash, suspended their operations entirely. In a matter of weeks, Russia's trade capacity in the Black Sea fell by more than half. Port workers faced mass layoffs as ships were redirected to neighboring countries. Warehouses overflowed with unsold oil and grain. The once busy docks grew quiet, echoing the same stillness that had already consumed the Baltic. Small traders tried to continue operations under the radar, using smaller ships and third-party flags, but their efforts were costly and dangerous. With every passing day, the pressure on Moscow increased. The loss of two of its main maritime corridors didn't just threaten its economy it threatened, its identity as a global power. For ordinary Russians, the change was subtle at first: fewer imported goods, longer delivery times, higher prices. But for those watching from the outside, it was clear that a major shift was underway. The collapse of the Baltic Black Sea trade lines was not just a logistical failure. It was the slow unraveling of a system that had kept Russia connected to the world. The announcement from Moscow's transport ministry came late at night. As if timing could soften the blow, a brief statement confirmed what traders and analysts had already suspected. Key Baltic and Black Sea routes were officially closed until further notice. The phrase was vague, but the implications were enormous. Within hours, global financial networks lit up with panic. Energy markets reacted instantly, with crude oil prices surging as traders scrambled to reprice risk. Major shipping firms suspended their Russian contracts, and European ports reported a sharp increase in redirection requests. Economists called it the $50 billion shockwave, a crisis that sent ripples across continents. For Moscow, this wasn't just a logistical disruption. It was a collapse of economic arteries that had pumped life into the nation's trade system for decades. Foreign investors, long wary of political instability, saw the shutdown as a final warning sign. Western conglomerates froze pending projects, halting billions in planned infrastructure and industrial development. Asian firms, once eager to fill the Western void, began reconsidering their positions. The uncertainty was simply too great. Freight insurance had become prohibitively expensive, payment channels unreliable, and sanctions unpredictable. Even traditional allies hesitated to engage deeply, fearing secondary penalties. The Kremlin's reassurances fell flat. Each press conference promised swift recovery, but behind those words was quiet desperation. Reports from within the finance ministry described late-night meetings, emergency calls with foreign ambassadors, and frantic attempts to negotiate exemptions or alternative trading terms. None succeeded. Across Russia's ports, the human cost became visible. Thousands of workers were left in limbo, unsure if their jobs still existed. Shipping yards once crowded with containers were now graveyards of idle cranes and rusting ships. The loss of trade wasn't just an economic number. It was a wound to the national psyche. For years, Moscow had invested heavily in building itself as a resilient global hub, an alternative to Western systems. Now, that vision had collapsed under the weight of isolation. The $50 billion in losses represented more than money. It symbolized the fading of a global role. In Europe, warehouses adjusted, companies restructured, and routes shifted. But in Russia, time seemed to freeze. Inside the corporate towers of Moscow, another storm brewed. Global companies that had weathered earlier crises were finally packing up and leaving. The exodus was swift and coordinated. Major Western firms, including logistics giants, energy corporations, and consumer brands, quietly evacuated their staff. Even non-political industries, technology, pharmaceuticals, retail closed operations. Asian and Middle Eastern firms that had replaced Western presence also began downsizing, citing supply chain uncertainty and rising transaction risks. The government tried to contain the panic by offering subsidies, tax relief, and property concessions, but the flight continued. The business community understood that this was not a temporary pause. It was the dismantling of a foreign investment ecosystem built over 30 years. The visual transformation of Moscow's skyline told the story best. Shiny glass towers bearing international logos went dark one by one. Cafes once filled with foreign professionals stood empty. Hotels that had served global clients began advertising to domestic travelers, slashing prices to survive. Russian state media called it strategic decoupling, but everyone knew what it really was: a retreat. The economic map of Russia was shrinking, and with each departing company, another door to the world closed. Within months, the loss of foreign capital became measurable. Analysts estimated a 70% plunge in direct investment, while small businesses dependent on imported parts or international partnerships went bankrupt. The stock market, already fragile, dropped further as confidence evaporated. Even loyal Russian corporations began quietly transferring assets abroad, preparing for a prolonged period of isolation. The Kremlin responded with patriotic rhetoric, urging citizens to support domestic industry and trust in national strength. But these slogans did little to fill the empty office towers or revive the halted ports. What had begun as a maritime crisis had now become a full-blown economic exodus. Russia's global business footprint was shrinking by the day. The closure of its port lines had triggered a domino effect, cutting off trade, draining investment, and driving out the very partners it once depended on for growth. The illusion of resilience had vanished, replaced by a stark reality. The nation was retreating into economic solitude. For foreign companies, the decision to flee was no longer about profit, it was about survival. And for Moscow, the consequences of losing those partnerships were beginning to unfold, one silent office and one darkened port at a time. Inside Russia, the fallout spread far beyond the borders of its silent ports. The shutdown of the Baltic and Black Sea trade lines triggered a domino effect across the nation's economy. Industries that had once thrived on exports began to crumble under the weight of stagnation. Truck drivers who used to transport goods from factories to ports found themselves without work, their fleets parked and unused. Farmers unable to export their grain or purchase the machinery and fertilizers they once imported faced catastrophic losses. All companies ran out of storage space as exports ground to a halt, forcing them to scale down production or shut wells entirely. In rural areas, food shortages became common, while in major cities, the prices of everyday goods surged beyond affordability. Supermarket shelves that once displayed imported items from Europe and Asia began to look sparse, replaced with lower quality domestic substitutes. The government launched emergency programs to stabilize supply chains, promising citizens that Russia could become self-sufficient. State television broadcasted stories of national innovation and industrial resilience, but on the ground, the reality was far less optimistic. Small traders turned to black market operations, trying to move goods through unofficial routes via Belarus and Central Asia. Those routes, however, were expensive, dangerous, and unreliable. Many shipments disappeared or were seized en route, leaving business owners bankrupt. Inflation quietly devoured savings, and even loyal citizens began questioning the cost of economic isolation. In cities like Moscow and St. Petersburg, frustration began to surface despite censorship. Long queues at gas stations and markets became normal, while social media filled with videos showing rows of unused containers rusting in abandoned port areas. People began to whisper that the government's control over trade had collapsed far more than it was willing to admit. Some economists privately warned that the crisis was worse than the sanctions of previous years combined. The mood in the country shifted from denial to resignation. Russia, once a proud exporter and global power, was now struggling to sustain its own population. The crisis had not just closed ports, it had closed doors to opportunity. Months passed, and the full weight of isolation began to sink in. What was once seen as a temporary disruption had transformed into a permanent reordering of Russia's economic existence. The Baltic Black Sea closure marked the beginning of a new era, one defined by retreat rather than expansion. The Kremlin attempted to reframe the crisis as a strategic shift towards self-reliance, launching campaigns to promote domestic production. Yet, factories lacked critical imported components, and technology firms could not access essential software or machinery. The dream of a self-contained economy quickly collided with the reality of modern dependency. Foreign powers adjusted without looking back. China, India, and Iran offered limited cooperation, But their deals came with strings attached and volumes far below Russia's former trade capacity. Western infrastructure projects completely bypassed Russian territory, investing instead in new corridors through Europe and Central Asia. For decades, Russia had positioned itself as a bridge between continents, a nation too important to isolate. Now, that bridge had collapsed, and no one seemed in a hurry to rebuild it. Inside government circles, discussions turned from expansion to preservation. The goal was no longer to grow but to survive. Moscow's economists quietly admitted that it could take decades to recover from the loss of global market access. The ruble remained unstable, and confidence among local investors evaporated. The younger generation, who once dreamed of international careers, began seeking ways to leave the country, joining the slow but steady wave of professionals migrating abroad. By the end of the year, the signs of decline were impossible to ignore. Once busy industrial zones stood quiet, the gleaming port terminals that symbolized Russia's connection to the world had become monuments to an era that no longer existed. The $50 billion loss had transformed into something much greater, a lasting wound on national pride and economic identity. In speeches, the Kremlin spoke of resilience, but behind the optimism was fear that the country had crossed a point of no return. Russia had entered a new isolation, one of its own making and one it could no longer escape easily. The Baltic and Black Sea ports, once the veins through which wealth and influence flowed, were now lifeless scars on the map. The world moved on, creating new alliances and trade paths that no longer included Moscow. For the first time in generations, Russia found itself truly alone, cut off, constrained, and forced to face a future without the global reach it once took for granted.